simultaneous, reverse, and improvement exchanges, and provides nationwide services to its clients throughout the national IPX 1031 network. So with that, please take it away, Greg.
Thank you, Kate. Good afternoon, everybody. I hope everybody's doing well. I have been doing exchanges for quite some time now, about 22 years, and I've never seen our volume do what it's doing right now, which is kind of going crazy. So I want to talk a little bit about, kind of what we're seeing from a political perspective, and also talk about, what we're seeing from a transaction standpoint, where money is flowing, all that kind of good stuff. And then I'll be happy to, to answer any questions. I'll go through the, nuts and bolts of kind of 1031 and make sure that you guys get all up to speed so you feel comfortable about talking about it. So as far as what's been happening with exchanges, the market has been steadily increasing. Obviously, I thought during the pandemic, I think probably a lot of us thought that the market would slow, and it did slow for a little while. And then, rates got to be so low that the market kind of just took off. It happened we saw it happen kind of late May and June of last year, and the market just kind of, got legs and kind of kept on running. And it's kind of kept on running ever since then. The residential market was fueled by people that owned investment property that were looking for, opportunities to, maybe buy a vacation home somewhere. We had lots of transactions where people were selling properties out of vacation areas, looking for maybe traditional type of investment properties. We're seeing a lot of people, though, trade into these vacation market areas. We're seeing a lot of money flow into different parts of the country. We're seeing, exchange dollars flow into Texas. We're seeing probably the number one market we're seeing money go into is Tennessee. Nashville area seems to be the hottest market in the country from where we can see dollars flowing, at least from California, that is. We're seeing money flow into Arizona. We're seeing money flow into Idaho, which is actually one of my relatives lives up there, and they said prices literally have tripled in the last probably 12 months. And that's due to California money that's going up there and buying a property. And then we're also seeing some fair amount of money flowing into Utah. Now, obviously, you guys are in the market here. There's no shortage of people that are willing and ready and able to buy property here. So, we're not running into an issue where we're like losing all of the people that we have to buy real estate. Those people are just fine, and they're here and they're still buying real estate. We just have people that are exchanging into investment properties in other areas of the country. The tenant laws in California can be a little bit rough for landlords, and so we're seeing people that are transitioning into other markets, or they're transitioning into different asset classes. And so we're opening about, I think last week we opened about a little more than 1,000 exchanges. And so there's just a ton of volume in the market. And so the reason that volume kind of kicked up exponentially is that the commercial market about 6 months ago started to come online. And so, the residential market has been strong, and then you're adding the fact that now the commercial market is kind of coming online. And so that has really fueled the, the exchange market. That coupled with the fact that, there's been talks about, with our current president about, first he talked about doing away with Section 1031. Now he's talking about capping it. And so we'll kind of talk about that. That's obviously fueling people to do these transactions as well. And so what happened was when President Biden was campaigning for office, probably 4 or 5 months before the election, he said that he wanted to do away with Section 1031. He thought it was a loophole for real estate investors to not have to pay taxes. And then he mentioned it twice during his campaign, and then he never mentioned it again. And then he got into office and he didn't mention it again. And so we have been working with and meeting with elected officials for the last, since the 2017 tax reform bill was put into place. We thought that there could be a shift in government. There was a shift in government, and so all of those meetings, all of those fundraisers, benefited us. So we had been speaking to people in the House Ways and Means Committee, House members, members of the Senate, about the importance of 1031 for the real estate economy. And so it actually, when the president put it in his proposal, it kind of came out of left field because, nobody in government was talking about it. So we're really not sure, how that's going to ferret out. So the proposal currently that's in place is not to eliminate 1031, but is to cap it for up to $500,000 for individual taxpayers, or up to $1 million for a married couple. There's only a couple lines out about it, so we don't know exactly what that means and how that would potentially look. And the thing that most people have to understand is that the president doesn't write these types of laws. They're written by, in this case, they're written by the House Ways and Means Committee. So the House Ways and Means will come out with a bill, and then in that bill, there will be like, hey, we want to eliminate, we want to reduce 1031, or we want to increase corporate taxes, or we want to increase individual taxes on high, income earners. That'll all be in a tax bill. And so, you hear of things of like, okay, we're capping 1031. You hear the president talked about raising capital gains tax rates to 36%. And currently the rates are 15 and 20%. And then they're talking about raising corporate taxes back to 28%. And so all of these things are kind of in play right now. We're going to have to see kind of what they shows up in a budget and what shows up in this, essentially in this bill. We don't think, we're hopeful that 1031 is going to will not show up in the bill. We have, spent a lot of time and a lot of effort making sure that, that they understand why 1031 exists. It's good for the, it's not only good for the real estate economy, but it's good for the overall economy. And it does generate a lot of revenue in tax dollars for even local governments, right? I mean, if you have a client, let's say, that bought a duplex, in your market, and they paid, $250,000 for that, asset, 15 years ago, and today that asset's worth $1 million. Well, with the current property tax, Prop 13 in California, their property tax on that investment is very low. If they don't ever sell the investment, it just slowly kind of comes up, right? But if somebody sells a property as part of a 1031 exchange, then what it does is it gives, basically the new buyer is buying the property at $1 million, so they're paying property taxes at $1 million. And then you have, that person that's doing a 1031 exchange, they're doing an exchange, they're going and buying a property for $1 million or more. So they're paying an increase in property taxes. Then you have, transfer taxes, you have, ordinary income taxes that people pay, on real estate commissions and escrow fees and title insurance fees, and the inspectors that go out and do these inspections, and the appraisers that go out and do the appraisals. All of that stuff that happens in a 1031 exchange in a regular real estate transaction, all of those people pay taxes. So, ultimately we had a study done by, we actually had two studies done, one by Ling and Petrova, which are these economic professors, talking about the benefits of 1031. And then we had Ernst & Young also do a study showing that the benefits of doing 1031 exchanges and keeping it in the tax code. It has been in the tax code for about 100 years. And so we're optimistic that it's going to stay. We do think that they are going to increase capital gains taxes. And so that's another reason why we see people selling. I have clients that, I talked to a client today that was kind of on the fence on doing an exchange or cashing out. And I said, well, not the worst time in the world to cash out, right? I know you're going to pay taxes. Nobody ever wants to pay taxes, but you have, real estate prices that are kind of at an all-time high, and you have capital gains tax rates that historically are pretty low. When I first started with the company, they were 28%, then they went to 25%, then they went from 20%, and then they went down to 15%. And so, historically, the rates right now are relatively low. And, the current administration is pretty committed to trying to raise those rates. Now, we don't think that they're going to actually push the rates to 36%. There's kind of a diminishing point of no return when it comes to capital gains taxes. And that rate is around 27 or 28%. So anything above that, and people just won't sell real estate. It gives them kind of a lock-in effect where they won't sell their stocks, they won't sell real estate, they won't pay taxes because the taxes are just too high. Because you remember in California, you're going to have to also pay California state taxes. And for a lot of us, that rate is about 13%. So if you have a federal capital gains tax rate, right, which was 36%, and then you had California state taxes, which is 13.3%, now you're looking at 50%, plus, you could get hit with healthcare taxes, which is another 3.8%, plus you have recaptured depreciation tax. You're talking about taxes that could run in the mid 50% range to sell a real estate asset. So it's not, beneficial to raise rates that high. We think that they'll probably end up, like I said, around 27 or 28%. They're also talking about raising the corporate tax rate. The proposal, I think, was to raise it back to 28%. I think that number is going to probably end up at 25%. But we'll just kind of have to see. There's a lot of dissension amongst the ranks right now, and there's a question of whether or not they can you'll be able to pass these types of bills. It is not easy to pass sweeping tax reform. We had the 2017 tax reform bill that was passed, but the last time tax reform was actually passed was in 1968. So, and the reason is because it's a couple reasons. One, there's a kind of an old rule of thumb in Washington, which is if you give somebody money, they won't remember you. But if you tax them come election day, they will remember you, and not in a positive way. So, these elected officials that work are supposed to work for us. I think a lot of them kind of think they work for themselves. They're career politicians for most of them, and they're, wanting to get reelected. So they have to be a little bit careful. I know that there's a lot of pressure on the elected officials in New York to do away with that SALT tax, your ability to write off more than $10,000 on your federal return. And so there are, a lot of pressure on people in New York saying, listen, if you don't, eliminate this SALT deal, we're not going to give you the money that you need to get reelected. So there's lots of, things at play right now. It's a very interesting time to kind of watch what's going to unfold. I'm hopeful that 1031 is going to remain intact. If it doesn't, and it gets written into this current way that they've proposed it, there are probably ways that we can get around it. It talks about being able to deduct up to $500,000 for a taxpayer, or up to $1 million for a married couple. Well, if you had a married couple that was selling a property, they could probably form a couple different entities, and get away with not paying taxes on more than just that $500 or that $1 million. So that's kind of what's going on in Washington. We have a grassroots campaign that we've started. We have a letter writing campaign that we've done. And I think last time I checked, we had written about 45,000 letters and sent that to our elected officials. That's not us writing it. That's, individuals like yourself. If you have not done that, you can go onto our website. It's very easy to do. You can certainly, quickly write a letter. It automatically generates it for you and sends it off. So that's an effective way to combat against it. We've, have a PR firm that's working for us. The National Association of Realtors is working for us. So there's a lot of people involved that understand that 1031 is good for real estate, good for the overall economy, and we're hoping that our elected officials also see that. So that's kind of where we are, as far as the, a view from the Capitol goes. I will say, let's check the chat here. A lot of the questions that I get are, will they make it retroactive? So will they, if they change 1031, will they make it retroactive? And from what we looked at the Green Book, it doesn't look like that's the case. If they changed the policies on 1031, those would not be retroactive. Those would go into effect in January 1st of 2022, assuming it gets passed this year. Now, if they don't pass anything by September, October-ish, they probably aren't going to pass anything, because October, November, candidates start running for their reelection. And so they're not going to want to do anything to kind of alienate any potential voters. So we're probably going to see Nancy Pelosi, who's kind of the chairman of the House. She has said she wants to get this bill onto the floor and voted on before July 4th, which is, I think, when they take a recess. And then the Senate is looking to try to pass it by sometime in September. So that's kind of the dates that we're kind of looking at. As soon as, obviously, that legislation comes out, I'm sure that it will, be out, so you guys will see it. If not, we'll definitely have it out so you guys can see it. So now that we kind of know kind of what's going on from a perspective of 1031 exchanges, what's going on from a political climate, let's kind of dig into the kind of nuts and bolts of 1031, what we're seeing, how the process works and that kind of stuff. So for those of you who haven't done an exchange, or maybe you're new in the business, 1031 is a section of the tax code which allows someone that owns investment or business use property to sell that property and exchange it for another property that they intend to hold for investment or business use. And the ultimate goal of doing that exchange is deferring the taxes from the sale of that property into a new property. So it's a way that you can take money, money that you would have normally paid in taxes and kind of reinvest that money in the real estate economy. And that's one of the things that kind of keeps the real estate economy moving from an investment standpoint. So it has to be investment or business use. It doesn't have to be income producing. So a lot of people think that in order for an exchange to, for a property to qualify, it's got to produce income. It does not have to produce income. Vacant land qualifies. A lot of vacant land doesn't produce any income, but it's property that you've, bought with the intent of holding it for investment or business use. So, it's pretty wide open on, what you can buy, what you can sell, as long as it's real estate. People hear of these rules, they're called like-kind rules. Like, I've got to buy a property that's like-kind to the property that I sold. The like-kind rules only simply mean that you are selling real estate that you've held for investment or business use, and you're buying real estate that you intend to hold for investment or business use. So the type of real estate that you buy doesn't matter. So I could sell vacant land, I could go buy a duplex, or I could go buy an industrial building. I could sell commercial, buy residential. It doesn't make any difference. I could sell property in California, buy property in Phoenix or Nashville or wherever I want to buy. As long as it's U.S. property, you cannot exchange foreign property for U.S. property, and you can't exchange U.S. property for foreign property. And the reason for that is because it's too easy to basically launder money by doing that. And so they don't want money coming in and out through Section 1031. You can do a foreign exchange. So we do have clients that own property in other areas. So you might have a client that owned, like I did one time for a client that owned a property in the UK and sold the property and exchanged it for a property in one. It was in Turkey, and then one in Turkey, one in Poland, and one in I think it was Russia. So you can do foreign exchanges, because if you're a U.S. taxpayer, you sell these assets. If you have gains, you have taxable liability. A lot of people don't realize that they can exchange out of California. California has always had a clawback provision. So California allows investors to exchange out of the state. They've always allowed investors to do that. But they've told the investors that if they ever sell these properties that they purchased out of state and they cash out, they don't do another exchange, that they were required to go back to the state of California and let them know, hey, we sold this asset and we're here to pay you our taxes. Well, as you guys could probably imagine, there were not a lot of people doing that. So it was like, hey, I sold this property in California. I did an exchange. I bought this property in Arizona. 5 years go by. I sell the property in Arizona. California doesn't know about it. Most most taxpayers were not going back to the state and saying, listen, I know you didn't know that I sold this property in Arizona, but I did sell it and I'm here to write you my check. So because of that, California developed a filing requirement that says, okay, we'll allow you to exchange out of the state of California into another state, but we're going to require that you show us something, you file something with us every year showing that you still own that asset. And if you ever decide to cash out of it and pay your taxes, we want our money at that point. So that's kind of in play. There is an interesting case study going on. He doesn't actually know he's a case study, but one of my clients moved to Nevada, sold all of his California real estate and moved it into like Nevada, Arizona, and a couple other states. And so I called him one day, and this was kind of when the rule was new, it was about 5 years ago. And I said, hey, Tim, what are you doing about this filing requirement for California? With all these properties that you exchanged out of California. He said, well, I'm not doing it. I'm like, what do you mean? He said, well, I'm a resident of Nevada. I don't own any more California real estate. What is the state of California going to do to me? And I'm like, I don't know. Let me know how that works out. So he doesn't know he's a case study, but he's actually a case study. So I'm going to see what happens. I certainly would not suggest to any of your customers that they don't, do that filing requirement, but it's not really a very big deal. So let's say you've got a client that owns a duplex and they're talking to you about, selling their property. The one thing that you want to do, especially in today's market, make sure they have some kind of plan or some kind of goal in place that they're trying to accomplish by selling the property. The people typically that we see get into trouble on their exchanges are ones that do virtually no planning and don't really have a game plan in place, right? You should be trying to accomplish some type of a goal, right? If I'm selling my duplex, why am I selling it? I can't just be selling it because it's worth, I paid $250, now it's worth $1 million, right? That's not a good reason to sell. You know why? Because everything else out there has gone up just like my duplex has. So it's not like I'm going to be selling high and buying low. I'm going to be selling and buying in the same market. That's why it's called a trade. So there has to be a reason why you're doing it. Oh, I want to buy property in another state. Or, oh, I want to be a more passive investor. So I'm going to look for something that produces, cash flow for me, but I don't have to manage. Some people do it because they don't want any management responsibilities. I want to sell this duplex. I'm tired of dealing with tenants and toilets and termites and taxes and all the fun things that are associated with owning real estate. I want to be a passive real estate investor, which has spooled a huge segment of the market. I don't know if any of you have ever heard of a net lease investment or triple net lease. You see them everywhere. There's, Walgreens, Walmart, Dollar Tree, Jack in the Box, Carl's Jr., 7-Eleven, all of these Starbucks, all of these properties are not owned by that tenant. They're owned by, an investor. But that tenant basically is responsible for the maintenance of the property. They're responsible for the taxes. They're responsible for the insurance. So basically the owner of that property just gets a check. They pay their mortgage and what's ever left over is theirs, right? So it's interesting because when I first started 22 years ago, I knew one person in Encino that did triple net lease investments. Today, I probably know 400 or 500 agents that specialize in only triple net lease investments. It's become probably 20 to 30% of, I would say, the market on the commercial side. When I say commercial, I mean apartments, industrial, office, retail. It's become a huge segment of the market. And the reason is because you have clients that own these apartment buildings, or they own duplexes, or they own fourplexes, or whatever it is. They don't want to manage property anymore. They want to be more more of a kind of casual investor, more of a hands-off type of owner, they buy into these deals, they buy these deals up, then they just collect a check every month. And the nice thing about these deals is that it's net income, right? So if the deal says it's going to pay me 5%, then, basically I earn, 5%. It's not like an apartment building where, hey, my apartment building, it's like a 4% cap rate, but I've got to pay for, maintenance issues. I got a tenant that just moved out. I got to redo that unit. You don't have all of those issues. With a triple net lease investment, you just have, you just collect rent basically, because the tenant wants to act as a true owner of the property. So that's why they typically sign these triple net leases. You don't even pay property taxes. The property taxes are paid by the tenant. So it's become, an interesting form of ownership. Is it bulletproof? No, right? If I own, let's say, a Bed Bath & Beyond, I heard from my wife, and I hope I'm not spreading rumors because I don't know if it's true or not, but I think that Bed Bath & Beyond are going out of business. Well, guess what? If I own a Bed Bath & Beyond, I'm going to have an empty store soon, and I'm not going to have a tenant to pay me rent. So, and if they're not going out of business and anybody knows about Bed Bath & Beyond, I apologize to Bed Bath & Beyond. I just heard it from my wife. So you got to look at these things. And the interesting thing about these triple net leases too is that they've opened the market up to the entire country, right? If I own a McDonald's in, I don't know, let's say Alabama, what does it matter, right? Because, McDonald's is still paying me rent. So it doesn't really necessarily matter where I own the real estate because I'm not managing it. I don't have to worry about, McDonald's calls me up and says, hey, somebody drove into the side of the building. Not my problem. McDonald's has the insurance. They're acting as a true owner of the asset. Their responsibility is to fix the asset. So I think that, it's become an interesting form of ownership. There's another segment known as the Delaware Statutory Trust. For some of you probably know about it, some of you don't know about it. These are basically large sponsors that go out and buy these big properties. They'll go buy like a 200-unit student housing, apartment building by, a university. And then they'll sell off proportionalized interests in those properties. So if I have a client that, let's say, wants to sell a duplex for $1 million, they don't want to go buy their own net lease investment because they don't quite have enough money, but they do want to be a passive owner. This is another segment that they can go into, which gets a passive investment. And so it's not bulletproof either. These are real estate investments, so they're taking just a risk just like they would if they're buying another real estate investment. So I'm not promoting any of these. I just want you to know that they exist, because I think a lot of our customers don't understand what they can or can't do with the funds. They go, oh, I own these 3 or 4 investment properties. I'd like to sell them, but I don't want to pay taxes and I don't want to go buy, a bunch of other houses. So, I think I'm just going to keep them because I know what I have. Well, they may be a good candidate for, to buy something that's more of a passive type of investment. So client owns a duplex. They decide they want to sell the property to an exchange. They should come up with a plan in place so that they know what they're trying to accomplish. They hire a real estate agent just like you would on any other transaction. That real estate agent markets the property for sale just like they would any other property. Does not affect the buyer as far as the 1031 goes. Property goes, they get an offer on the property. They want to counter that offer with some language to the effect that the client's doing an exchange. And then they're going to open up an escrow once they get a fully executed contract. The only thing that's different about a 1031 than a regular transaction, just from a sales standpoint, one, you got to put some language in the contract to the effect that the seller's doing an exchange. And two, before escrow closes, and if you don't remember anything that I say today, remember this one thing. Before escrow closes, the client has to hire a company like ours, a qualified intermediary, accommodator, facilitator, whatever you want to call us, prior to escrow closing. So they would, reach out to us, say, hey, I've got an escrow set up with ABC Escrow Company. Can you please reach out to that escrow officer and get that exchange set up? We'll reach out to the escrow officer, get a copy of the contract and title report. From that, we'll draw our exchange documents up, and then we'll send them out to get signed. Once they're signed, the client's exchange is set up. Sale closes. The proceeds from the sale are sent over to us and held at trust with for your client. At that point, your client has 45 days to identify a property that they would like to purchase, and then they have another 135 days after that to get it closed. So they have 45 days to identify, plus 135 days after that to get one of those identified properties closed. Now, a lot of people are thinking right now, well, I thought they had 180 days. It is 180 days. So 45 plus 135 gets you to 180. The reason I don't tell clients anymore that they have 45 days to identify and a total of 180 days to close is because I get so many of clients over the years that just add 45 to 180 and come up with like 225 that the problem is that you don't have 225 days. So it's 45 plus 135, a total of 180. So I want to talk a little bit about the identification rules, how you identify property. Basically, it's pretty easy to, there's two basic rules that people use. So when your client closes on their sale, we're going to send them a couple things. We're going to send them out a letter showing what their 45th and 180th day dates are. We're going to send them out an accounting statement so they can use that to show proof of funds. And we're also going to send them out an identification statement that they can use to identify properties on. So there's two basic rules that people use to identify properties. There is a 3-property rule, which allows them to identify basically 3 properties. The 3-property rule doesn't limit the value of property that they can identify. It just limits the number of properties that they can identify to 3. Now, if you have a client that wants to diversify, there's another rule called the 200% rule. And that rule says you could identify up to twice the value of the property that you sold at any number of properties. So if I sell my duplex for $1 million, I could identify up to $2 million worth of real estate. So let's say I was looking to buy $500,000 condos in Florida. Well, under the 200% rule, I could identify 4 of those instead of only identifying 3. So I could identify 4 properties that were $500,000 each. So it gives me an added benefit of being able to identify 1 more property. So typically those are clients that are going to diversify. They're going to sell 1 property, buy multiple properties. They're going to use the 200% rule. And then there's another, rule, sell 1, buy 1, which is what most people do. They use the 3-property rule. But remember, the rules don't say you got to sell 1 and buy 1 property. The rules say you can, you could sell multiple properties. You could buy 1. You could sell 1, buy multiple. You could sell a fee simple interest in a property, buy a tenant in common interest. So the rules are pretty wide open on what you can do there from a real estate perspective. So when they get to their 45th day is when they should identify properties. They typically are going to write in the addresses of those properties. They're going to sign that form that we sent them and date it. They're going to send us that form. We're going to countersign it and date it and then put it in their file. And then they will have identified those properties. So someone had a question about where the funds go. So the funds don't stay in that escrow. The funds upon the close of the sale come over to the qualified intermediary accommodator, a company like ours, and are held in trust for the client. So when, if you're using, let's say, Fidelity Escrow or whatever it is, or lawyers or any of the escrow companies, when you sell that property, escrow will send the funds over to a company like ours, and then we'll open an account for that client. And that's kind of one of the reasons why you want to use a large company like myself. I don't own IPX. It's the name of our company, Investment Exchange Inc. We go by IPX 1031. It's wholly owned by Fidelity National Financial, which is the largest, title insurance company in the country. They're the same company that owns, Fidelity Title, Chicago Title, Lawyers, Commonwealth, Security Union, and a host of other companies that exist out there. And when somebody does an exchange with us, our parent company, F&F, provides them with a $50 million performance guarantee. So they're guaranteeing the funds while we're holding on to them. We also have $100 million in Fidelity bonding insurance, and we have $30 million in errors and omissions coverage. So the money that when a client's doing an exchange with us, they can know that the money is safe. Our industry is not regulated. You don't have to be licensed or bonded, so anybody in here could go open their own exchange company tomorrow. So it is important that when you use a company that they have sufficient assets and guarantees, and they hold the money the correct way to make sure that the money remains safe. So another question is, can I sell a property for $200,000 and then can I use that money to go buy a property for $800,000? Is there a limit to the amount of money that, the size of the property that I can buy? And the answer to that question is no. You can buy as large a property as you want. So under the 3 property rule, remember, it doesn't limit the value of property I can identify. It only limits the number of properties I can identify. So if I sold my duplex for $1 million and I really wanted to leverage up, let's say I had no, debt on the property, and I wanted to leverage it by, I don't know, by $2 million, I could identify 3 properties that were each, $3 million each. In fact, I could, identify the, Brooklyn Bridge if I wanted to. It doesn't make a difference. So, you can buy, the sky's the limit on how much you can buy. Most people typically try to just get done what they need to get done for their exchange, and then they can refinance out afterwards if they want to take on additional real estate. So an example of that is I had a client who sold, it was a fairly decent sized asset. It was like $22.5 million. They had basically they had $1 million of debt, but just for this example, we'll assume they had no debt. So they wanted to go buy a bunch of real estate, and they wanted to leverage this money by about 50%. So they wanted to buy about $45 million worth of real estate. I said, don't do that. Take the funds, do your exchange, buy your $22.5 million that you need, and then refinance out 50% of the money. So in this case, it was about $10 million, $11 million, $10 million because they had $1 million of debt. But so it's $10 million they refinanced out. Then they use that $10 million to go buy another $20 million worth of real estate assets. And so the reason that's a better scenario is because once they've bought their $22.5 million, they've completed their exchange. Now they refinance. With the refinance money, it's not part of an exchange. So they have as much time as they need to go find a replacement property. So it's a better, I think, way to go. If you're buying multiple properties and you had a large sale. So now we're in an exchange. Once you've identified those properties, you're past your 45th day. You are married to those properties. You cannot, substitute them. You cannot, replace them. It doesn't matter what happens. The seller could, you could have a perfectly good contract and they could back out. You are stuck with the properties that are on that list. So it's very important that you do as much due diligence as you can and get as much done as you can as early on as you can. I tell my clients, be aggressive early. I completed an exchange, a personal exchange for myself about 3 months ago. I sold the property. I wanted to buy a property in La Quinta, which is out in the Palm Springs area. It's a pretty desirable market, pretty tough to get into. In the first 30 days, I made 13 offers, all over asking price. And it took me to the 13th one till I actually was able to get one. So you want to tell your clients, be aggressive early. Once you get something under contract, try to get all of your due diligence done as quickly as you can so that you're not in a situation where, after you've identified this property, you've gone under contract, you're past your 45 days and now you find out, oh, well, property was built on a pet cemetery and it's haunted, so I can't buy this property, right? You want to make sure that you get all of that done before, that 45-day period if you can. You can sell multiple properties and do an exchange. The only thing about selling multiple properties and doing an exchange is that your time clock starts ticking the date that the first escrow closes. It's always kind of funny to me. Agents call me all the time, and I'm an expert in a very narrow topic. I know a lot about one tiny little tax code, right? So I get agents that call me all the time that will say, I'm working on this deal, and it's a 1031 exchange, and I'm a brand new agent, and I'm concerned because I've never really done an exchange, and I'm always like, don't worry about it. It's no big deal. I can take care of it. And so this one day, this agent called me and she said, it's my first deal and I'm so nervous, and it's a 1031 exchange. And I said, don't be nervous. It's no big deal. It's just like regular transaction. Tell me what you have going on. She said, well, I got this client. They want to sell 8 properties and exchange it into one. I was like, okay, you can be nervous. Because it's obviously was tough. This is, a couple of years ago. It's tough to get that many properties sold and exchanged into, one property. And so what ended up happening is they ended up getting 6 of the 8 sold. We did a regular exchange on those 6. And then the 2 that hadn't sold yet, we actually ended up doing a reverse exchange on those 2. And I'll talk about the reverse exchange here as we get kind of towards the end. So you can do an exchange with multiple, properties. You just want to be sure, like in her case, what I just said, the first one went under contract. I said, okay, try to get a 90-day escrow. So she ended up getting like 81 days or 80 days or something. Great. Then the next one went under contract a little bit later. I said, try to get a 75-day escrow. So she got a 75-day escrow. The next one went under contract to get a 60-day escrow. And then as they kind of started going to contract, the escrow periods went down, 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 so that we could try to get them to close relatively close together. We couldn't get them all closed before we had to close on the replacement property. And so that's why we ended up doing a reverse exchange on the replacement property. Why do I think there's an increase in commercial exchanges? One, I think the market has kind of figured itself out a little bit. And two, I think that they're very nervous about the potential of them doing away with Section 1031 or or capping it. So I think the clients that are in deals right now that are saying, listen, I'm not looking to be in this deal long term. This is not the deal that I want to retire in. They're doing these exchanges and going to deals that they're retired, could retire in. We're not seeing a lot of exchanges in the office market. Obviously, that's a market that's taken a little bit of heat during the pandemic. I can tell you that 60%, our company we own, we have a lot of offices. It makes up a huge part of our payroll, of our expenses. And they're saying, I heard that this is a couple months ago that we're going to take on 60% less office space. I've been talking to law firms, and so they are also talking about taking on less office space. They have found that their attorneys are just as effective working from home. So the market will be interesting to see on the commercial side how it fares out. You have some retail that's gotten distressed a little bit, so it'll be interesting to see how we kind of emerge. Now, most people believe that the country and individual investors have a tremendous amount of amnesia, and so once we get far enough away from the pandemic that we're going through, that people will kind of forget and go back to traditional types of office. We'll just have to see. So one of the questions that someone asked is, someone sells a property, transfers it into a REIT type investment, can they sell later and buy back into traditional real estate? So there is a special election. It's called a 721 election, which allows somebody to exchange out of real estate into a REIT. Not all the REITs offer it. It's a special election. And what the client gets is partnership operating units in the REIT. And so they get paid dividends off of those operating units. But when they want to sell they've got to convert those shares through this thing called an UPREIT into stock. And once they've converted them into stock, they become taxable. So once you go into a REIT, you can never really exchange out of it. So I hope that that answers that question. Someone asked, what happens if I don't find a suitable property within 45 days? Will you release the funds from my original sale to me, and I'll just have to buy a second property as a normal purchase? Yeah, so if you have a client, we have lots of clients that are doing this. We have lots of clients who are selling properties, opening up exchanges, looking for a property for 45 days, seeing if there's something out there that they really like. And if they can't find something that they really like, they're just going ahead and paying their taxes. They're saying, okay, you know what? I can't find a property I really want. They come back to us and say, I'm not going to complete our exchange. We go ahead and send them their money back on day 46, and they go ahead and pay their taxes. So we have clients who are, attempt to do exchanges. We charge, our fee to do an exchange is pretty low. It's a flat fee. It's $850. So it's not a lot of money. And basically for, the clients look at it and they say, well, for $850, I'm going to buy myself another 45 days to go out there and look and see if there's a property that I can't live without. So I want to talk a little bit about reverse exchanges as we're kind of closing in on the 3 o'clock hour. I know that we have, up to an hour and a half, but I also want to give some time to, people to ask some questions about it if they have any. In a regular exchange, right, we have, property sells, money comes over to the exchange company, find the property you want, then they transfer the money over to, the other property, and you complete your exchange. In a reverse exchange, you're buying the property that you want before you sell the property that you have. And so, in order to do that, we actually have to take title to either the property that the client is buying or the property the client is selling. Most of the time, we try to take title to the property that the client is buying. It's a less expensive type of transaction for the client because they don't have to transfer a property to us and then we transfer the property to a new buyer. So let's say you've got a client that's saw one of your properties and they made you an offer, put it under contract, and they said, hey, I want to do a reverse exchange. So they hire a company like ours, and what we do is we create an LLC where we're the sole member, the exchange company is the sole member that assigns into the transaction. So we assign into the transaction as the buyer in this LLC. The client basically loans us the money to buy this property. For that loan, for that money, we give them back a note and deed of trust. So they, and then once we acquire this property in the LLC, once we close, we then triple net lease the property back to them. So they have all the management, all the control. We're just holding title, right? They collect rents, they make all the decisions, they have insurance. We just are holding title to it. From that day, it's a flip-flop of a regular exchange. So they will have 45 days to identify the property that they want to sell. Then they have up to 180 days to get that property sold. So once their property goes under contract in an escrow, we'll assign into that escrow just like a regular exchange. So when their sale closes, the proceeds from the sale are sent over to us, and then we use that money to pay your client back the money that they loaned us to buy this new property. And then once we've completed that, we then give them 100% interest in the LLC we created. So we do an entity transfer opposed to a property transfer. And the reason that we do it that way is so that we can try to avoid double transfer taxes. There are a lot of reverse exchanges going on right now. And the reason is because people are concerned that they're not going to be able to find a property. And I would say that I've never been in a market in the 22 years that I've been doing this where someone is, saying, oh, well, there's so much property on the market, I'll have no problem finding anything. It's never happened. Markets are always challenging to find good properties in. I would say today's market is probably as challenging as any, or probably the most challenging that we've ever seen, just because there's such a lack of inventory and there's so many buyers out there chasing that inventory that it can become very challenging. So It's important to have a plan in place. I like to build extensions into escrows, especially in the seller's market. So if you had a client that has that duplex, you get an offer, let's say, the one thing I tell clients do not do, unless you already have the property that you want to buy, do not get a short escrow. You get these clients who go, oh, they'll call me up, they go, yeah, I need to do an exchange. I'll go, okay, well, I accepted an offer yesterday. I'm like, okay, well, tell me about it. Up 10 days, all cash. I'm like, okay, well, that, unless you know what you're buying, that doesn't benefit you. If you have an all cash offer, that's great. Get a 30-day escrow. That buys you 30 more days, plus your 45 days to go look for property. So you want to try to avoid, those short escrow periods. People that are coming in saying they'll pay all cash and close very quickly like that, it's an incentive for the seller, but it doesn't benefit a seller that's in an exchange. So I think the better thing to do is to try to get a longer escrow period, and if you can, negotiate an extension. So say, okay, I want a 30-day escrow and I want one 15-day extension. So if I get to the close of escrow, I haven't found what I'm looking for, I have the right to extend escrow one time for 15 days. Now, a lot of people will say, well, what if I just put a contingency in there that says, I'm not going to sell until I find a suitable replacement property? Now, in today's market, you get away with that a little more than you would in other markets. But the problem with that is that, it's not like a home, right, where you're out shopping for a new house. It's an investment property. And so that could really go on forever. So my opinion is build extensions into the, into the escrow if you can. I think in today's seller's market, you probably could do that. And then that gives at least the buyer a sense of, okay, they've got 2 15-day extensions, but after that, they're going to close. But it would buy your client some time. Rosie is correct that, yeah, if you're going to a REIT, once you exchange into the UPREIT, you're not able to avoid taxes. We have a great website. Someone asked if IPX has a website. We have a great website. I would encourage all of you to go to it. I'll put it here in the chat bar. It's www.ipx1031.com. It's got a ton of information in it. And also I'll put my contact info in the chat as well. But talk to your clients about signing that, getting involved and signing that information, and for taxes. Telling people that you want 1031 to remain in the tax code. It literally takes, and I'm not kidding you, once you get to our website, it takes you like 1 minute. It's like super fast. And it's important that, 1031 is good for, real estate agents. Obviously it's good for us because we're an exchange company, but, it allows you the opportunity to earn 2 commissions with 1 customer. And a lot of people, I think as agents, we got kind of put ourselves into a place where we think, somebody owns an investment property, they clearly know, about 1031. And the reality of it is, what I found out, and I've done thousands and thousands of seminars, and I've probably done hundreds for agents who just invite some investors in, and I explain, the exchange process. I would say 90% of the people don't even know that you could sell investment house and go buy another type of investment. Now, what we're seeing a lot of people do is we're seeing a lot of people exchange into properties that we ultimately think are going to be their retirement home or a second home. Let's see here. Someone did ask a question. If a client sells one pumpkin patch and buys another pumpkin patch held for investment or business use purposes, and they close escrow on the second pumpkin patch on Halloween, would that be the ultimate 1031 exchange? That is a funny question, and that would probably be the ultimate exchange. Yeah, it's happy 1031 days. Halloween is the 1031's big day, I guess. So let's say you've got a client that owns a duplex, and they go, listen, I really would like to buy a beach house in Oxnard. and I'd like to sell I'd like to sell this duplex, and I'd like to use the proceeds to go buy a beach house in Oxnard. And you go, okay, well, what do you want to do with it? Well, I want it to be my second home. Well, second home doesn't qualify. It has to be held for investment or business use. Well, how do I do that? Well, a vacation home can qualify as an investment as long as you don't use that property for more than 2 weeks a year, and as long as you show at least 2 weeks of income on it. Now, people will say, well, how, is the government going to know how much time that I spend there? Well, one, they can look at electricity, fluctuations on when you're going out there. But, people will say, well, how can I spend more than just 2 weeks there? I don't know how many of you have owned a second home or a vacation home, but what I can tell you from my personal experience is that I spend probably 50% of my time at every one of my properties doing maintenance. And so anytime that you do maintenance on your property, it doesn't count against the time that you stay there. So if I go out and I do some painting, or like the property in La Quinta, I'm going to go out and replace all the light switches and all the plugs, that doesn't count against the 2 weeks that I get to spend there. So if you do that, you could spend more time there. You just have to document that you're doing maintenance. And then the question also comes out, okay, so I have this beach house. I've treated it as an investment property. How long do I have to treat it as an investment property? Because I really want to retire and move there. And can I do that? You can do that. And there's a revenue ruling out there that says any property that's been held for 2 years or more as an investment, in an audit, the IRS can't challenge the held for investment portion of your exchange. So if you do a 1031 exchange into a property, once you hold that property for at least 2 years as an investment, you can do whatever you want with it. And so we're seeing a lot of people right now exchange into places like Idaho and other places in the country that we ultimately think are going to be their retirement home, but they're going to hold them for investment for a period of time. And then after that time's up, you're going to go ahead and move into that property, and it's going to be their second home or their primary residence. So that's a way that you can kind of can combine tax codes. Somebody asked, can you please elaborate more on getting a longer escrow for the first property? We will receive funds at the end of the 30 days anyways. Did you mean short contingencies and then those extra days? No. So I'm talking about saying, okay, seller makes you an offer, all cash, let's say 15-day close. Well, my client's going to be in an exchange. They don't want a 15-day close. They want as much time as they can get to look for property. So they counter back and they say, we want a 30-day escrow, and we want one 15-day extension. So the seller has the right to extend escrow one time for 15 days. So they have a 30-day escrow. They get to the end of the 30 days. They haven't found the property that they want to buy yet. So they have the right to extend escrow for 15 days. And if they get to the end of the 15 days, they can't find what they're looking for, escrow closes, money goes to the exchange company, and then they're in that 45-day identification period. So the idea is you're trying to buy them time in escrow before they get into that 45-day period. So it's basically like the 45 days is a starting line. You're just moving that line backwards so that they can get more time to identify property. I can tell you that the hardest part of an exchange by far is identifying a property within those 45 days. Everything else is relatively simple. When somebody calls me up and says, hey, Greg, so-and-so told me to give you a call, we want to do an exchange, and our property we're selling is in escrow. We've already put the one that we're buying in escrow. The rest of it's easy. The rest of it's just paperwork. So typically finding the property that you want in the amount of time that you have is the biggest challenge when you're talking about doing 1031 exchanges. Proof of funds. If your property is still in escrow, right? So good question. So I've got this property in escrow. It's part of a 1031 exchange. I'm making an offer on a new property, but I don't have proof of funds because my sale hasn't closed yet. Now, if your sale is closed and the money's with us, we can send them an accounting statement. They can show that. What I typically tell clients to do is show them an estimated closing statement from the escrow for their sale. So they can submit that as proof of funds saying, listen, this asset's closing in 5 days or 10 days or whatever it is, and this is where our fund's coming from. Here's a estimated closing statement to show you where those funds are coming from. I think other than, if you have money in the bank, you can also show that as proof of funds as well. All right. Now, I'm going to stop talking, for a second, and I'm going to allow anybody to kind of jump in. If they have questions, they can ask questions. You can type it in the chat. I'd be happy to answer any questions that anybody has. And then if nobody has a question, I'm going to talk a little bit about refinancing before and after exchanges. And then I'm going to turn you guys loose out into the real estate market with this newfound 1031 knowledge. All right. Okay, please discuss boot. So boot is anything that's not like-kind real estate. So, in a regular exchange, and I didn't mention this, is a good reason why this person brought this up. So Barry said, talk about boot. Well, the thing that I didn't mention, which is very important, are the reinvestment rules when you do an exchange. So anytime you do a 1031, in order to not pay any taxes, right, defer all your taxes, you've got to do a couple of things. You've got to buy something that's equal or greater in value to the property that you sold, and you have to reinvest the proceeds from that sale. So let's say I sold my property for $1 million. I paid $60,000 in real estate commissions, escrow, title insurance fees. So my net sales price is $940,000. I've got to go buy a property that's $940,000, and I have to reinvest all the proceeds that I received from that sale into that new property. But let's say I find something that I really love. It's only $900,000. So I have to buy $940,000, but this deal's only $900,000. So I go ahead and buy it. Can I do an exchange? I can still do an exchange. I can still defer taxes, but that $40,000 is the difference between the two is going to be considered boot, and I'm going to have to pay taxes on it. You can also take cash boot. So let's say that you have a client, we have clients that do this all the time, that are selling an asset off, and they say, oh, well, you know what, I'd really like to take $50,000 from the sale. You can take $50,000 from the sale, that's what they call cash boot, and you'll pay taxes on that $50,000. So you can certainly do that. Now, there does come a point where, partial exchange doesn't work anymore. So I had a client call me earlier today. They're selling 4 properties in a portfolio for $4.6 million, and they're buying a deal for $1.4 million. Their basis in the properties is $3 million. So they're not going to defer any taxes if they buy a deal for $1.4 million. So for them, it didn't make any sense to do an exchange. So there are times where it doesn't make sense to do an exchange because you're not going to defer any taxes. But I also had a client that was doing an exchange that was going to be short like $120,000. And so they said, okay, well, I'll see if there's something additional that we can find that we can put this $120,000 into. But if there's not, I'll just pay taxes on the $120,000. I think their gain was like $400,000. So they'd be deferring taxes on, $280,000 and paying taxes on $120,000. So, so you can certainly do a partial exchange if you want to do a partial exchange. All right. I quickly want to talk about refinancing. You don't want to refinance a property right before you sell it and do an exchange. When I say refinance, I mean refinance cash out. If you're just refinancing the loan because it had to be refinanced or you got a lower rate or anything like that, that's not a problem. But if you refinance a property, take a step to take cash out, and then sell it, exchange it, and go buy a new property, the IRS could collapse that transaction. There's a particular doctrine called the step transaction doctrine, which kind of disallows that and allows them to collapse the entire transaction. But on the backside of the transaction, they don't really have an issue with it. So if I sell a property for, $1 million, I do a 1031 exchange, I buy a new property for $1 million, and I want to refinance out $200,000, as long as it's part of 2 separate transactions. So I close on the purchase, and then I have a refinance, which are 2 separate deals. The IRS doesn't seem to have an issue with that. We have not seen any clients have any issues with that. There is a lot of information here. I know I go through a lot. I don't want to miss anything. And I think there's some people on here probably that, have a higher education level, have been in real estate for a longer period of time, maybe do more exchanges. So I want to make sure that there's something in here for them. And also make sure that, the people that are new or that don't do a lot of exchanges, they also have the information. So another question. In my example, a party made $1 million after buying for $3 million. If they sell, they have to pay taxes on the $1 million. Do they not? So in my example, someone bought a property roughly for $3 million. They were selling it for $4 million. They're going to go buy an asset for $1.4 million as part of a 1031. That wouldn't help, right? So they won't start deferring taxes till they buy over $3 million. So in their case, they would pay taxes on that $1 million. So Tammy has said that it'll be live up on the website at the end of today. You guys can also reach out to me if you have any questions. We also have webinars on our website that you can sign up for. So if you say, hey, you know what, I feel like I got like 20% of what Greg said today. First of all, you're probably ahead of all your competition. But if you wanted to learn more, you can go to our website and sign up for a webinar there. We have our attorney, Jim Miller, who gives those every month and does a great job. I also can send Tammy and Kate, I can send them a copy of our booklet and our brochure on 1031 that they can blast out to everybody that attended the course. And that way you'll have all of that information right at your fingertips. I'm here to help you guys in any way I can. We have one-page overviews on 1031s. I have postcards that you can mail out to non-owner occupied people. We have booklets and brochures and flyers on individual topics. So we're here to help you in any way that I can. My office, I have 2 offices, 3 offices in Southern California. I have an office in Monrovia, which is kind of by, I actually have an office in Santa Barbara. I'm not there very often, but I have an office in Monrovia, which I primarily spend most of my time in. I have an office in Newport Beach, an office in Carlsbad, and then an office in Santa Barbara. So I'm going to fire that information to Tammy and Kate. I want to thank you guys for allowing me to be on this call, and I look forward to hearing and working with you guys in the future.
Thank you, Greg. I think we have all learned from the information you have shared. We appreciate your time and your extensive knowledge of how 1031 exchanges work. Thank you, everyone, for coming, and have a wonderful rest of your day.
Thank you.